make sure that you have attempted this question under exam conditions before watching the recording. If you just watch the recording, you're not going to get the full benefit from this question. Okay, so to start, we've got 15 minutes to work through the information that we've been provided with in the scenario. So let's start with that first. Gourmet Coffee House, or GCH, manufactures coffee products. The company has two divisions, namely the coffee division, which manufactures instant coffee, and the cappuccino division, which manufactures instant cappuccino. Both the instant coffee and the instant cappuccino are sold in powder form. Absorption costing is used by both divisions. All right, so if absorption costing is used, we know that when they value inventory, they include both variable manufacturing costs and fixed manufacturing costs in the value of inventory. Head office is responsible for all long-term financing agreements and also determines the rate and method of allocating the head office administration fees. Head office also delivers training services at a standard tariff to the divisions at the request of the divisional management. The divisional managers are responsible for their own procurement function, including negotiations with suppliers, the management of debtors, capital investment decisions, day-to-day cash management, and other sundry expenses. The divisional managers are awarded with a bonus of 80,000 Rand each if the residual income of the division exceeds 1.5 million Rand. The company's cost of capital is 16% per annum. All right, so first we are given information relating to the coffee division. So let's see what we've been told. The division has a maximum manufacturing capacity of 220,000 kilograms of instant coffee and is budgeting to run at 95% capacity. The budget assumes that all instant coffee manufactured will be sold to external clients at a market price of 150 Rand per kilogram. All right, so let's just make sense of this information over here. We've been given their maximum manufacturing capacity, so that's the maximum that they can manufacture, and we know that they are budgeting to run at a 95% capacity. So using that information, we can easily calculate what they budget to produce or what they budget to manufacture. The 220 kilograms multiplied by 95%. We then also know that all instant coffee manufactured will be sold. So whatever they manufacture is going to be sold, and the selling price per kilogram is 150 Rand. The budgeted variable manufacturing cost per kilogram amounts to 60 Rand. The division incurs additional budgeted costs of 24 Rand per kilogram to package and deliver the instant coffee to all external customers. All right, so that's all of the information relating to the coffee division. Next, we are given information relating to the cappuccino division. The division manufactures two products, namely regular cappuccino and unsweetened cappuccino. And they use 250 grams of instant coffee to manufacture 1 kilogram of cappuccino, regardless of the type of cappuccino manufactured. All right, so what we can see here is the cappuccino division obviously manufactures cappuccino. However, one of the ingredients that they use to manufacture the cappuccino is instant coffee. And we know that the coffee division manufactures instant coffee. So let's see what we're told in the next paragraph. The cappuccino division currently acquires the instant coffee from an external supplier at a cost of 120 Rand per kilogram. So currently they are not buying the instant coffee from the coffee division, but rather from an external supplier. And we are told that the company is investigating the possibility of transferring the instant coffee needed by the cappuccino division from the coffee division. All right, so instead of buying the instant instead of buying the instant coffee from the external supplier, they are looking at transferring it internally from the coffee division. But currently, the instant coffee is purchased from an external supplier. All right, then next you've been given the standard cost, and the selling price per kilogram is as follows. So you can see for both of the cappuccinos manufactured, the regular cappuccino and also the unsweetened cappuccino, first we've been given information relating to the standard cost per kilogram. So be careful guys, this is all standard information. We've got direct material, direct labor, variable overheads, and also fixed overheads, giving us the total standard cost. You've then been given the budgeted selling price per kilogram for each product and also the budgeted sales volumes. All right, so that's all of your standard and budgeted information. Then just below we have some actual financial results for the year. So first we have revenue, and in note 1 we are given more information relating to revenue. We are told that 48,000 kilograms of regular cappuccino was sold at 290 Rand per kilogram, and 43,800 kilograms of unsweetened cappuccino was sold at 310 Rand per kilogram. So that's what makes up this revenue number over there. Then next we have profit before tax, and we have more information in note 2 relating to profit before tax. You are specifically told that the profit before tax was determined before the following income and expenses were taken into account. Okay, so the following income and expenses have not been taken into account in the calculation of profit before tax. Interest paid on a long-term loan, interest paid on bank overdrafts, training services, discount received from creditors, discount allowed on debtors, depreciation, head office administration fee, and sundry expenses. All right, then let's just see what other actual information we've been given. We've been given the non-current assets, debtors, creditors, bank overdraft, and also the long-term loan. All right, then finally we have information over here relating to a special order. The division has received a request for a special order of 50 kilograms of a hazelnut flavored cappuccino. All right, so they don't currently make a hazelnut flavored cappuccino. They have a regular cappuccino and they have an unsweetened cappuccino. So we are told that the regular cappuccino will be infused with hazelnut flavoring using a specialized machine. So if they do accept the special order, all they'll do is they'll take the regular cappuccino that they currently manufacture, infuse it with some hazelnut flavoring, and they'll then have a hazelnut flavored cappuccino. Now, this infusion is going to be done using a specialized machine, and you're told that the cappuccino division purchased the machine for another order 6 months ago at a cost of 64,800 Rand. The machine is depreciated over its useful life of 5 years. The machine can be sold today for 50,000 Rand. However, if the order is accepted, the machine can be sold for 45,000 Rand after the order has been fulfilled. There is just enough hazelnut flavoring in stock, which cost 1,500 Rand. And this hazelnut flavoring is going to expire soon. And if it's not used for this order, it will need to be disposed of at a cost of 400 Rand. The order will take 1 month to complete, and the division has sufficient capacity to fulfill the order. All right, so as soon as you see that, if we know that they have sufficient capacity to fulfill the order, we won't have an opportunity cost. Because remember, an opportunity cost only arises where you don't have sufficient capacity, where the company needs to sacrifice something as a result of the special order. So there won't be any opportunity cost over here. Because they have enough capacity. The accountant calculated the minimum price per kilogram for the special order of hazelnut flavored cappuccino as follows. All right, so we can see how the calculation over here has been performed by the accountant. First, let's just make sense of what we've got over here. They've taken the cost of a regular cappuccino. So if we go up to the standard information that you've been given over here, for the regular cappuccino, you can see we have a cost of 270 Rand per kilogram. So that's the starting point in his calculation. And the reason for that is because obviously we know they're going to take the regular cappuccino and infuse it with hazelnut flavoring. So we need to take into account the cost of the regular cappuccino and then just the additional costs that specifically relate to the order. So that's where this cost over here is coming from. And he multiplies that obviously by 50 kilograms because we know that this order is for 50 kilograms of hazelnut flavored cappuccino. All right, and I don't want to look at this in too much detail right now because we don't know what the required is going to ask for. So it just makes sense of his calculation. That's all. Then he's taken into account depreciation on the specialized machine. He's taken the cost of the machine. We were told it's depreciated over 5 years, so that's why he's multiplying by 1/5. We were also specifically told that this order is going to take 1 month to complete, and that's why he's multiplying by 1/12 to get the depreciation. All right, so whether this calculation that he's performing right now is correct or not is questionable. Let's not worry about that for now. We'll see when we get to the required. But at this point, you should already start doubting what's going on, especially from that depreciation amount over there, because we know that depreciation is not a cash flow, so it's not relevant. So this calculation already, we can see there might be a problem here, and potentially when we get to the required, we're going to have to discuss the mistakes that have been made in this calculation. Then he's taking into account the purchase and sale of the specialized machine. So the machine was purchased for 64,800 Rand, so that's a cost. And after the special order has been fulfilled, it can be sold for 45,000 Rand. So that's where that's coming from over there. So the net cost there is 19,800 that he's taking into account. Again, it's questionable whether that has actually been done correctly. Then for the hazelnut flavoring, we know that they have enough hazelnut flavoring in stock, and it was purchased for 1,500 Rand. And he's saying that that original cost is a sunk cost, so it's not relevant. That's definitely correct over there. And then he takes into account a saving for this order because we were specifically told that the hazelnut flavoring is going to expire soon, and if it's not used for this order, it has to be disposed of at a cost of 400 Rand. So that's also correct what he's done over there, because if this order is accepted, it will save the company 400 Rand of having to dispose of that hazelnut flavoring. So that is a saving associated to this order. He then calculates the minimum price. He divides by the 50 kilograms to get the minimum price per kilogram. All right, so that's his calculation over there. But we'll look at that in more detail when we know what the required actually wants from us. All right, guys, then that's everything that you've been provided with in this scenario.